Hello and welcome to The Point. I'm Neil Stanley, and today we're going to talk about expectations for cost of funds. What drives cost of funds? Well, obviously the economic conditions are a big part of it, the interest rates, and the balance sheets of the financial institutions in our industry. When you look at cost of funds over time using the FDIC data, you find that cost of funds has increased, of course, dramatically, but it is not as high as it has been in the past. And even though interest rates have stayed now for a year at 5.25 to 5.5%, cost of funds in the first quarter of 2024 was 259 in aggregate. So let's look at the economy. We see GDP growing. We see the interest rate for Fed funds being held constant now for about a year. We see unemployment at a relatively low level, 4.1. And we see the PCE dropping, but still above levels that it was at in previous times. So what is the forecast for interest rates? The FOMC met in June and did this dot plot where they said that they were going to be between 5 and 5.25 to end the year. That was the forecast for the majority of the participants. And then to end next year, someplace between 4 and 4.25. Meanwhile, since then, the Fed funds futures market has predicted that rates are going to fall even a little bit faster. They now have predicted that the Fed funds futures market is now predicting a 4.85 for end of year 2024 and 4% for mid-year 2025. So let's look at something though that I think we need to take into consideration: loan to deposit ratios. Back in before the recession, we had loan to deposit ratios that were much higher than they are today. Of course, they dropped dramatically in the pandemic and have risen, and so we've seen a little bit higher loan to deposit ratios, but they're still much lower than they were over the time frame when interest rates were higher before. When we plot Fed funds and cost of funds, we see that cost of funds peaked in 2007 at 3.58. Today we're approximately 100 basis points less than that with the first quarter at 2.59. So even though Fed funds is higher, we've been able to keep cost of funds down, relatively speaking. So why is that? I think when you look at the loan to deposit ratio, you see the answer. The balance sheets of the banks indicate that the competition for deposits to fund loans just isn't anywhere close to what it was when Fed funds were at the level that they are today. So yes, loan to deposit ratio has increased, but it's still in the mid 60s compared to the mid 90s that we looked at back in 2007 level. So what do you think lower interest rates will do? There's certainly an indication that loan demand might be a factor because we've seen history when loans increased to much greater levels than they are today. But do we really think deposits are going to grow? So if we have a situation where deposits are stagnant and loans are growing, the competition for those deposits could well be established to be significant. And that might mean that although interest rates, which will continue to be a driver and are a key factor of driving cost of funds, may be only one of the variables. Because if the loan to deposit ratio were to increase, it could be that that's going to offset a lot of the decline in Fed funds rates. So we want to be mindful of that, and we want to not let our guard down when it comes to strategies about deposits. We keep in mind that back in when interest rates were declining the last time they went from the above 5% level, we had unemployment rate in 4.7 and we had PCE down to 2. So the difference between that unemployment and PCE very substantial. Today, the unemployment is at 4.1, significantly lower than it was back in 2007. And inflation is still much higher than it was back then. So with inflation up, unemployment low, and GDP growing, it could be that the competition for funding is very, very relevant. So while I do believe that there could be some moderation in interest rates, in other words, I do agree with the forecast that the Fed is going to reduce at least some level of interest rate reduction, the increase in loan demand could potentially uh, allow very little cost of funds reduction and certainly very little reduction in the deposit competition. This is just a very different world than what we've seen in the past. So we wanted to be mindful of that and share that with you as you think about your economic condition. We want you to feel very comfortable setting up an appointment with me. You can see my Calendly link right here on the screen. It is always a pleasure to introduce and prepare this material for your benefit. I hope you found it to be valuable, and I look forward to presenting the next episode of To the Point. Until then, make it a great day.